Rauchenwald. It's been a while. We had some potentially technical issues. Now it says the stream is scheduled to start at what, like May 23rd? Yeah, like that actually is already or not. So maybe you're still having technical issues. Trying to figure this out. Okay, on desktop there it says upcoming live streams, and technically I'm already live, so why does it still say upcoming? May 23rd, we already have that 3:33 p.m. Maybe the time zone is an issue here. That might actually be a problem. Where's the time setting for that garbage? Okay, now we're apparently live, yeah, so I'm not sure where, do we have a delay? Is there a huge delay? Is there no delay? Okay, apparently there is a delay now. Kind of frustrating, but yeah, anyway, so hello and welcome, oops, wrong button. Hello and welcome to another live stream with me, Christian Rauchenwald, on this first day. Markets are open. It's been a while since I streamed. As always, usually disclaimer, everything that I share in this live stream / video is my personal opinion and no way financial professional advice of any kind. You should always do your own research, consult certified professionals, draw your own conclusions, and make your own decisions. Now, that said, it's been a while since I streamed. It's also been a while since I originally started the channel, and I'm trading a little bit more actively recently, and I'm also a little bit more active, or at least passively active, on Reddit, and I saw a couple of posts. I personally started to dig more into options trading, and as a result, I also noticed the sentiment about options trading on Reddit. If we switch, I think that button should do the trick. Yeah, no, wrong screen, sorry. That button should do the trick. So like, for example, here we have a post that is like, how does it come that every once in a while we fall again for this options thing? And so basically complaining about that people spend money on options. If we look for options, then we have like mixed sentiments. So some people are for it, some people against it. Then we have posts like this that are like, why I think buying and directly registering shares is better than exercising calls, with some random examples that just show like the downsides and whatnot. And I figured, since I started to dive into options, I'm gonna either record a video or make a short live stream to share my perspective. I obviously could also write a post on our GME or Superstonk or whichever subreddit is right now the one to go for GameStop, but it just didn't feel, or I didn't feel like writing a lot, so that's where it went. Yeah. Now, yeah, like the whole thing is the following. We're going to cover some option basics, and we're going to obviously focus on GameStop during the streams. I might record a general video about options, but like there are a few cool things that I learned about options. Obviously, options overall are a fairly complicated matter, and you can lose a decent amount of money and whatnot and blah, blah, blah. But they are also quite cool once you understand certain aspects. Now, I said I'm just sharing my opinion, so make sure to do your own research, yeah? But for those of you that have no idea about options, I'm gonna drag my camera somewhere where it doesn't cover the options panel. Let's put it down here for now. On one hand, you have so-called call options that basically gives you the right, if you buy a call option, you're buying the right to buy 100 shares of the underlying asset at a predetermined price up to until the expiration date of the option. So if we take a June 21st option and we would buy the 25, so the call option with a strike price of $25, it would give us the right to buy GameStop shares, and to be more precisely 100 GameStop shares at a price of $25 up until June 21st, no matter the price. Now, obviously, if GameStop trades at $20, it doesn't make sense to exercise that option because we would overpay. But if GameStop trades at $100, we would actually still buy it for $25. Yeah. Now that's a call option, and when you buy a call option. Yeah. On the other hand, you have so-called put options that give you the right to sell an asset. So if we were to bet against GameStop, for example, we could buy the $20 put option for June, and that would give us the right to sell 100 shares of GameStop for $20, no matter what the price is of GameStop at the time, which means if GameStop trades at $15 and we sell 100 shares, we would pocket the difference. Yeah. So that's the buying side of call and put options. I think that's like as simple as it gets. It gives you the right to buy or sell 100 shares. On of the underlying asset at a predetermined price up to a specific predetermined date, the expiration date. Yeah. Now, where things become interesting is when we look at a few other sides. So, for example, when you buy a put option asset, it gives you the right to sell 100 shares. Whereas on the other hand, when you sell a put option, it actually gives you the obligation to buy. Yeah, which might now sound a little confusing, but if we consider the following, let's say that's the GameStop chart. For those wondering the tools I'm using, you can find them linked in the description down below. So let's say I would want to increase my GameStop position. So I could here say I'm going to make a new trade, buy, and I'm going to say I want to buy 100 shares and I want to buy at $20 per share. Yeah, so I just would create up $20 per share. So I would just submit that as a limit order. And with that, I would have my limit order. And basically, if GameStop touches 20 per share, my order gets executed and I buy 100 GameStop shares for $2,000. Yeah, which I can then directly register or whatnot. So yeah. However, alternatively, I could sell, for example, with the June 21st expiration date, that $20 put option. Now, what does that mean? If I again buy that option, I'm actually betting against GameStop. But if I sell that option, it means that somebody else right now would pay me around $485 for the right that if GameStop falls below 20, I would actually have to buy at 20, 100 shares. So if we fall below 20, my obligation would be to use $2,000 to get 100 GameStop shares at 20. However, I still pocket the $4.70 per, for this contract. So times 100, $470, which means even if GameStop falls in this case below 20, my average would actually be at 15.30 because I'm going to make this sure that it's like, so everybody understands it. We are forced to buy we are forced then to buy 100 shares at 20, just like if we would have set a limit order at 20. However, we also got 470 in premium paid. So actually 485 would be the middle value right now. Yeah, which means our average would be our actual cost would be 1,530, which means our average would be $15.30 per share. So this is one example where, in my opinion, options are great. Now, that's just my personal opinion, but do with that as you will, because I mean, the downside here, if we talk about downside, is the following: that if GameStop, what is the downside here? Actually, the only downside here is so that's the only. So if we circle back to the limit order, we would have one at 20. Then obviously the first time the price touches the 20, it would execute our order. Yeah, assuming there is a counterparty that actually sells the shares at 20. Blah blah blah. So we would get our shares immediately. Whereas if we have the option has an expiration date, and when we sell the option to someone else, they can execute that option at any time until the expiration, or if at the expiration date, so on June 21st, we are below 20, it would automatically execute. Yeah. So which means if we just briefly dip below 20, we wouldn't get the shares potentially because the person that buys that option from us might not execute it immediately. Yeah. But if GameStop dips below 20, we would actually, as said, get those shares for effectively for around $15 something instead of $20, because the person that sold us the option would pay us $482, which also means they likely will not execute it unless it falls below $15.30 or $15.20, because otherwise it would not be profitable for them. Their break-even price, if we look at the profile for this option, we can see that the break-even price is not shown, but it would be around $15.35, for example. So that's the point where if you buy that option, you actually start to get into profit. So if GameStop trades at $17, our counterparty for the trade will likely not execute the trade, so we wouldn't get the shares assigned. Yeah, not guaranteed, but I'm just saying, like, if it's not automatically executed, they wouldn't execute it because they actually still shorted at a loss. So doesn't make much sense. Yeah. Now, the core point, however, is you can either buy 100 shares at $20, for example, and you have 100 shares, you spend $2,000, you have the shares settled within 2 days, and then you can directly register them, which is kind of cool. Yeah. However, on the other hand, you can sell the put option, get right now, because the volatility is relative high, with 230%, so the implied volatility, get paid around 480, 460, whatever dollars for that option. If the price dips below till June, there is a chance that the counterparty will execute the trade, so which means forcing you to buy 420. You get your 100 shares, but you still pocket at the $400 premium. Yeah. If the price stays above 20, so like if we have a limit order at 20, but it never dips to 20, we just can look at our limit order, it never executes, so nothing happens. And we don't make any money, we don't lose any money. However, with the option, with selling the put option, if the price stays above 20, we still pocket the $482 premium, which you could then use to buy, I don't know, like 25 shares or 20 shares at 20, or 20 shares at the current price or something. And you didn't pay for those shares because you got paid the premium. Yeah. Now, that's one thing. Now, one downside, so we have one downside, a limit order would trigger immediately, whereas the put option would not trigger immediately. So not the first time we touch 20 would you get the shares, but it depends on if the option gets exercised and so on. But it's still comparable, in my opinion, to a limit order, because we are, but with the benefit that we already make money just by setting the order. Yeah. So we are selling somebody the option, and that makes us obligated to buy the shares at 20 when the option is exercised. Yeah. So that's one side of the whole thing. Now, the second downside of the whole thing potentially is that, okay, what if GameStop explodes in the meantime? Yeah, because like if you buy 100 shares right now for 2,000, what's the current rate? Where do we have GME? For $2,085, yeah. And GameStop explodes in 5 minutes, yeah, well, then you are on the rocket and you make a ton of profit. Now, obviously, if you just sell the put option, you don't have that because you don't have any shares yet. And then other people would be, yay, GameStop is let's say, I don't know, like let's say at $1,000 per share and are fucking rich, and you just pocketed $570 or $480 for your option, and that's it, yeah. So, but that's where then call options come into play, in my opinion, and like, I get the hate for call options. You know, if I were to buy a $25 call option, so strike price 25 for June, I would have to pay, as you see, between $450 and $475 just for the right to buy GameStop at $25 per share. And we see it would need to reach at least $29.77 for me to be break even. And if we do not go to $29.77, I actually lose money. Yeah? And with those 400, whatever the medium here is, with those $460, let's say, or yeah, let's say $460, I could just as well buy a couple of shares and have the shares. And if we go to the moon, I'm part of the journey and I profit. Yeah. However, right now, when we have such high implied volatility and options are fairly expensive, what you can do is what I did, for example, here is a so-called risk reversal. Yeah. So if we look, for example, at the profile again of buying the call option, it looks like this. Yeah, so we can, let's assume 100% move in GameStop. So you can see that we have a long area where we are just losing the $465 premium. Then we have the area where we start to get into or recover, but we're still at a loss. So we're looking at the solid line, by the way, which is at the end of the option or at the option expiration date. The dotted line is at what it is the value at whichever date I select here. Yeah, so if we say end of March, for example. Yeah, so we have an area where we just lose $465 and we get nothing in return because the option expires worthless. And we have an area where we're still at a loss because while we are above 25, we still have to also recover the $467 that we paid. And then we only have the area where we are at a profit. Yeah. So that's obviously not a good scenario because it means we risk almost $500 to potentially buy the right to buy at 25. But if the ship doesn't take off until June, then we just lost almost $500 that we could have used to buy regular shares. Yeah. However, right now I said with the high implied volatility, where if we sell, for example, a 20 put option, we get around, now the price even got higher, $490 would be the middle value right now. So on the other hand, we could buy, for example, let's say a $30 call option. Yeah. As a result, the $30 call option right now costs around $385. But as said, the $20 put option gives us $490. So we have a difference of around $80, and our profile looks like this. And it looks like this for two simple reasons. So we again focus on the solid line. Yeah. On one hand, we sold the put option for which we got paid or would get paid $490. Yeah, that is the obligation for us. If GameStop falls below 20, we are buying 100 shares at $20. So for a $2,000 commitment. Yeah. On the other hand, we have the $30 call option that is the right to buy 100 shares if we go above $30. Yeah. So which means if the stock falls below 20, we have to put up $2,000 or bring up $2,000 to pay for the 100 shares, and we have our shares. We can directly register them and move on. Yeah. On the other hand, if we stay above 20 but we stay below 30, well then both our options are worthless. The put option is out of the money that we sold, which means we just pocket the 490. And our call option is also not in the money, which means we lose the, what did we say, 380, yeah, roughly 85, yeah, which means we still net pocket $77 in that scenario, yeah, so 75, 77. So if we are above 20 and below 30, we still pocket money. However, the moment we go above 30, we also have our call option, which gives us the right to buy 100 shares at $30 per share. Yeah, which means at the last day of this option in June, the graph looks exactly like this. And if GameStop were at 35, we actually are part of the journey. Yeah, so I hope that makes sense, which means we actually make a profit by saying, okay, we're willing to buy 100 shares if we fall below 20, and we're willing to buy them at 20. Our break-even price then would be $19.20 because we net earn around $80 on that option, which means if we end up being obliged to buy the shares, then our average would still be not 20, but 19.20 or 19.23, because we can consider the $77 or $75 premium that we got as well. So we still get a slightly better entry than we would get with a 20 limit order. If the price doesn't go below 20, we just pocket the premium difference, which in this case would be $75. And if we have, or if the rocket already takes off, we're still part of the journey starting at $30 upwards. Yeah. Now, we can do that even further. So for example, yesterday prices were obviously different. Yesterday, I sold the $20 call option and bought the $100 put option. Vice versa, I sold the $20 put option. So I'm saying if we fall below 20, I'm going to get another 100 shares for 2,000. And I bought the $100 call option because we both know if GameStop really explodes, then it will go, or like I assume personally, it's my personal opinion and so on, that if GameStop really explode, it will shoot above 100. What happens is that the 100 call option is much cheaper, obviously, than the $30 call option. So the profile looks different, which means if we stay above 20, but below 100, which we don't even get to see here, I just pocket the difference. And the difference in that case is around $300. Yeah, which means I get paid $366 or 300 something dollars in that case. Let's say middle price, $337 for doing those two options. For selling the put option, it would be around $490 that I receive. And the $100 call option costs me around $150. So the difference would be $337 right now that I receive. If GameStop falls below 20, I'll buy 100 shares at $20 per share. If GameStop shoots above 100, I'm still part of the rocket. And again, I mean, everybody's saying, phone number prices and so on, yeah. So it doesn't really matter if it's a 30 call option or a 100 call option, in my opinion, yeah. But either way, I profit. So financially, in quotes, the worst case scenario that could happen is if GameStop falls to $10, I'm still obliged to buy them for $20. But because I earned or I got $337, my average would still be at 16.63, so not that bad. So if GameStop falls to $10, I would be only 30% down on my position. However, if I buy 100 shares right now for, let's say, I buy $2,000 worth of GameStop shares right now, and it falls down to $10, I'm at a 50% loss. So while I don't know, I mean, I get there are like situations. So if somebody tells you should just buy call options, obviously, I mean, you do your own decisions and so on. But personally, I think that also would not be the greatest idea right now because the premiums are high and you pay a lot of money. And if GameStop doesn't shoot high enough, you just wasted your money. Yeah. However, doing both, and just selling put options just to collect the premium, yeah. So just to collect the money here, and then, however, maybe not even getting the shares because the price doesn't move far enough down or so, and then the rocket starts and you miss the journey. Also doesn't seem like a good idea. Yeah, I mean, to me personally. Yeah. But right now, with the premium as high as it is, it seems like a good idea to me the assumption is obviously that you're willing to buy 100 shares either way. Yeah. I mean, if you don't have the money for 100 shares at 20, you don't have $2,000, or you don't want to buy another 100 shares, then obviously none of that is for you. Yeah. But if you anyway plan to get another 100 shares, then it seems to me that a setup like this is the smart play. Or you can also do it differently. You can also say, okay, I'm going to sell because the premiums are quite high right now, I'm going to sell, let's say again, let's check again, the 100 call option costs 150 right now. So on the other hand, however, even the $16 put option pays you more. So you could buy a $16 put option and have the 100 call. You'd still have a net difference of $67. So you'd earn $67 on the whole thing. If GameStop falls below 16, you get to buy 100 shares at 16, although your average would be 15.33. If GameStop stays above 16, but below 100, you just pocket the $67. And if it really takes off, you still have your ticket to the moon because you have the $100 call option as well. Yeah. Now, obviously, the profile for the $100 call option looks like this. So it has it doesn't show the break-even price. Okay, never mind. Do we see it here? That's for May, for the last date. Yeah, so yeah, I mean, obviously we need to go above 100. Unfortunately, I cannot set it to show me or maybe there is a way to set it, I just don't know it, to show me above 100. But obviously you have to consider the cost. So theoretically, this option costs 310, which means it would have to go to 103.10 or so for that option to start to be in profit. But again, if the ship really takes off, you still would have your ticket. So you can either go in my opinion, conservative route and say, okay, I'm going to sell the lower put option, which pays less, but still then go with the 100 call option, for example. So you have a smaller guaranteed pay in quotes, or you can go with, no, I don't believe it will fall below 20. So you sell the 20 put option, and you're willing to buy 100 shares for $2,000 in case it actually falls below 20. So you would maximize your payout. So to around right now, I said now it's $330. So prices change obviously constantly. Or you want to have like the maximum pay here. So you don't believe it falls below 20. So you go with that to get your $400 something for the put option. But you also believe, or you also want to have a better ticket to the upside. And instead of going with the 100 call option, you go right now, for example, with the 25 call option, which still would have a net difference of $77. So you would get paid $77. And the worst case in quotes that could happen is GameStop falls far below 20, because then you would have to buy for $20 per share, and your 100 shares would be at a loss for now. Yeah, and once you have the shares, you can directly register them anyway if you want to, which makes sense, but it's not topic of this video or stream. And yeah, so for everyone that's out there and that is like, okay, I don't know, like here, how do we always fall for options, or why I think buying and directly registering is better than options and so on. It feels like, of course, if we just talk about buying a call option, you buy the right to potentially buy shares, and if it doesn't go high enough, you just lose your money. Yeah. However, on the other hand, if prices are high enough and you combine options properly, you get, in my opinion, really, really interesting profiles that pay you for either buying shares, so you get them at a lower price instead of at 20. You can subtract whatever profit you made on the overall option trade, and your average is lower, or you just pocket the premium. And especially if we again go back to the setup that I originally had, so we sell the 20 put and we buy the 100 call option, then we see that right now we would again get $337. So that's another 15 shares, 16 shares that you could buy with that money. And if we fall below 20, you still invest your 2,000 for another 100 shares. Yeah. If we shoot above, again, you have the call option. If we just are anywhere between 20 and 100, well, you still pocketed the $337, and again can use them to buy more shares or do whatever else you want with it. Yeah. So in my opinion, while there is obviously, if people just buy option, and especially when they're so expensive, then it has its downsides. But if you combine them properly, so if you set things up properly and prices play out right and so on, I think they can serve as a very, very good replacement for limit orders. I mean, don't have the same effect because a limit order triggers on the limit price. An option only gives you the shares once it gets exercised, but it pays you. Yeah. And yeah, so a replacement for limit orders. And there are situations right now where you could actually make money that you can then again use to buy more shares if you want to, by actually combining the options. So I wouldn't buy a separate GameStop call option because I just have the risk of losing the premium. I would obviously sell put options if I plan to potentially get more shares. And if I'm worried that the ship might already take off in quotes, then I would go for the setup that I just showed you during this video or stream, to combine the put options and the call options. So either I end up buying 100 shares, or the rocket takes off and I profit from my call options, or it's somewhere in between and I pocket the premium and can use that money to buy more shares that I then don't pay for myself. So those shares basically somebody else paid for. Yeah. Now, one can obviously argue, I mean, that's another area of the whole field where I am not deep enough into the whole material, that whatever, like selling the put option helps the opponents, the short sellers. Yeah, one can argue about that, but on the other hand, they pay you, which means you take money from, if you sell a put option, you literally take money from people that are betting against GameStop or whichever other stock you're doing that for, which means I don't think it helps them. Yes, it might bring the maximum pain point for the week down and whatnot. Yeah. But I don't think it really, really helps them, especially when we talk about GameStop. Yeah. Now, last but not least for today's stream, actually, like just a second. So it's anyway already longer than I wanted it to be. But yeah, last but not least for today is the following. One thing that always baffles me or surprises me when we talk about, or when I'm on Reddit and I look at GameStop. So everybody's saying, okay, GameStop will go to phone number prices. I mean, everybody, like on Reddit, in Superstonk, GME and whatnot, yeah, people are saying, okay, it will go to phone number prices. I will not sell before the price reaches a phone number and whatnot. And you have to directly register your shares. And again, I'm all for directly registering shares. There's even a video on the channel that you can check out about that, yeah. But the core point is, if we reach phone number prices, yeah, then does it really make a difference if you own one share or if you own 10,000 shares? So assuming you already have some shares, that's the core thing, and they are directly registered, so your broker cannot screw you over, yeah, sell them for you at a lower price, prevent you from selling at all or whatnot, yeah. But assuming you have at least one GameStop share directly registered at ComputerShare, then, and the assumption that everyone has, we won't sell unless the price looks like an international phone number, yeah. Does it really matter if you have one or if you have 50,000 shares? Shouldn't matter, because then the payout would anyway be with one share already insane, yeah? Even if it's not phone number prices, even if, I mean, it's still a huge price assumption, but even if the stock goes to $100,000, yeah, it's probably still life-changing for most people to some extent. So does it really matter if you have 1,000 shares or 10 or 1? Yeah, like, I mean, of course it's more money, but again, for many people it will still already make an impact, which means, in my opinion, and again, that's all it is, my personal opinion, if, like, when people are like, you shouldn't buy options, just buy, or you shouldn't do with options at all, like all options are bad and whatnot, and just buy more shares and directly register them. If you already have shares directly registered, I don't have a lot of shares directly registered, by the way. I have a 2-digit amount directly registered, so it's really not a lot, but I feel like that should be enough, yeah. So which means in the meantime, I can actually use options. I can use options to either get more shares. I can options to get money from the people betting against the company by selling the put options. I can use options overall just to make more money, yeah. And it feels like a little bit like a contradiction if you on one hand tell people we're gonna reach phone number prices, and on the other hand you tell people like, don't do options. You should, every single share should be bought and instantly directly registered, or preferably bought at ComputerShare and whatnot, yeah. It just seems like a contradiction. I mean, of course, the easiest outcome for the whole, or the easiest resolution for the whole GameStop situation would be if enough people would buy shares directly at ComputerShare or directly register them, so that we officially register the entire float, which would then instantly prove that every single other share that's on the market is actually fake, yeah. But that's unlikely to happen, yeah. It's simply unlikely to happen. I'm not saying impossible, but it's unlikely to happen, or at least not very, very soon, yeah. In the meantime, of course, the more shares get directly registered, the more, and that there's another contradiction, the more we directly register, the more likely it's gonna is to explode. But at the same time, you see countless posts that say, yeah, the shares are the shorts are just like naked shorting and creating synthetic shares and synthetic this and that and so on. So even if we have 99% of shares directly registered, well, it could still do that, yeah. So kind of like there are a lot of contradictions in the field, and I'm trying to focus on what makes the most sense for me. And what makes the most sense for me is, like, in that case, making money, having some shares directly registered. And when I'm considering to add more shares to my holding, then doing it in the way that's the best for me. And in that case, the best ways for me is like using the options that I just showed you. So combine either just selling put options to get paid. If the price goes up, I still have my couple of shares directly registered, so I'm happy about that. If the price does not go up, I pocket the, so if the price goes up, I have my shares to be part of the journey. And I pocket the premium, which is a couple $100 even for weekly options at the moment. And if if we look at, just for switching back for a second, if we look at the options for next Friday, yeah, so just selling a put option that expires next Friday would get you around $235. Yeah, right now, or wrong screen, sorry. Yeah, so would get you around $235 right now, that you can use to buy another 11 shares if you wanted to, or that you can use to go out for dinner or whatever. Yeah, so, but yeah, so my point is, like, my personal opinion is it makes sense to directly register some or all of the shares that you already have, so you cannot be screwed over by your broker and whatnot. But besides that, if you plan on buying more shares, of course, if you want to go ahead and just make a market order, set a limit order at your broker, but you can also consider what I just showed you in this video. And it doesn't only work for GameStop, it works for every stock that has high implied volatility. If you're planning to buy more shares, you could use a combination of selling a put option and buying a call option, so that if it drops, you get more shares at the strike price. If it stays above the strike price, you pocket the premium, which is also profit for you. And if it shoots up, you participate on the journey based on the call options that you have. Yeah. So, and it feels just so much, I don't know, I wouldn't say, yeah, like so much smarter actually than just simply buying the 100 shares on the market, because you actually have multiple angles here that you can play, and pretty much all of them are profitable. The only unprofitable thing is if the stock drops, and if you just buy 100 shares, well, if the stock drops, it's also unprofitable for you. Yeah. Anyway, that's it for today. Yeah, if you like this video or live stream, don't forget to like and subscribe. As always, enable notifications. There may or may not be more live streams in the future, since I'm right now more actively trading again. Yeah, so that's it. Thanks for tuning in. I wish you all a great rest of the week, and then see you in another live stream or video. Till then, bye-bye.